Konstantin Tarnarutsky thought he was being smart about his money. He found a high-yield savings app called Yotta that promised 4% interest, FDIC insurance through Evolve Bank and Trust, and even weekly prize drawings just for saving money. It seemed perfect. Too perfect, maybe, but the FDIC backing made it feel safe. So he deposited $7,400, his emergency fund, the money he'd saved for years working as a content creator in Toronto. Money he might need for rent, for food, for life. On May 11th, 2024, he tried to make a withdrawal. The app said processing, then it said pending, then it said nothing at all. A week passed, 2 weeks. He kept trying. Every transaction canceled, every attempt blocked. And when he finally got through to customer service, they told him something that made his blood run cold. The money doesn't exist. It's not held at Evolve. According to their audit of transactional logs, your $7,400 simply doesn't exist. Except it did exist. He'd deposited it. He had screenshots. He had confirmation emails. But somewhere between his account, the Yotta app, a middleman company called Synapse, and Evolve Bank, $109 million in customer money had vanished into thin air. And Konstantin wasn't alone. 85,000 people woke up that May morning locked out of $112 million of their own money. College students couldn't pay tuition. Parents couldn't buy groceries. Someone had to postpone surgery because the money they'd saved for medical bills was gone. Just gone. And 20 months later, as of February 2026, thousands still haven't gotten their money back. Some received checks for 99% of their balance. Others got less than 1%. And some, like Konstantin, got absolutely nothing while lawyers and banks and bankruptcy trustees argue over whose fault it is. This is not a story about a bank failure. This is a story about something far more insidious happening in American banking right now in 2026. Something that FDIC insurance doesn't protect against. Something that's affecting tens of thousands of people who did everything right, who chose insured accounts, who thought they were being financially responsible, and who learned the hard way that your money being safe and your money being accessible are two completely different things. Over the next several minutes, I'm going to show you exactly what happened to these 85,000 people, why it's still happening to new victims right now today, what the actual risks are that nobody's warning you about, and most critically, the specific steps you can take starting this week to make sure this doesn't happen to you. Because the Yotta collapse isn't an outlier. It's a symptom of structural problems in modern banking that are getting worse, not better. Let me explain what actually happened with Yotta, because the details matter and they reveal vulnerabilities that affect millions of Americans who have no idea they're exposed. Yotta wasn't a bank. It was a financial technology company, a fintech, that offered banking services through partnerships with actual FDIC-insured banks. This business model is called banking as a service, and it's everywhere in 2026. When you use apps like Chime or Dave or Cash App or Venmo for banking services, you're using banking as a service. The app itself isn't a bank. It's a front end connected to a real bank somewhere in the background. Here's how it worked. Yotta partnered with Evolve Bank and Trust, an FDIC-insured institution in Tennessee. When you deposited money into your Yotta account, that money was supposed to flow into what's called an FBO account, a for benefit of account at Evolve. The money sat at Evolve, protected by FDIC insurance, but managed through systems provided by yet another company, Synapse Financial Technologies. Synapse was the middleware, the technology platform that connected consumer-facing apps like Yotta to banks like Evolve. Synapse kept the ledgers, tracked who owned what money, processed transactions, and basically ran the plumbing that made the whole system work. This setup seemed fine on paper. Yotta got to offer banking services without becoming an actual bank, which requires massive capital and regulatory compliance. Evolve got to acquire deposits without building consumer-facing apps and marketing campaigns. Synapse got to provide technology services to dozens of fintech companies simultaneously, collecting fees from each one. Everybody wins, except for one tiny problem. When Synapse's ledgers turned out to be completely inaccurate, when the company couldn't reconcile how much money belonged to which customers, when they filed for bankruptcy in April 2024, owing more money than they had in assets, the whole house of cards collapsed instantly. On May 11th, Evolve Bank froze access to accounts linked to Synapse because they literally didn't know how much money each customer was supposed to have. Synapse's records said $112 million in Yotta customer funds were held at Evolve. Evolve's own audit showed only $1.4 million in Yotta accounts. Where did the other $110 million go? Nobody knew. Synapse blamed Evolve. Evolve blamed Synapse. And 85,000 customers couldn't access a single dollar while the companies pointed fingers at each other. Here's what makes this truly terrifying. Every single one of those customers thought they had FDIC insurance. Yotta's marketing materials explicitly mentioned FDIC protection. Evolve Bank is absolutely FDIC insured. But FDIC insurance only kicks in when a bank fails. Evolve didn't fail. The bank is still operating just fine. The problem wasn't that Evolve ran out of money. The problem was that nobody could figure out whose money was whose because the middleware company keeping track of everything had completely screwed up its record keeping. And the FDIC has made it crystal clear they have no obligation to step in when the issue is accounting chaos rather than bank insolvency. So customers were stuck in financial purgatory. Their money existed somewhere, but they couldn't prove it, couldn't access it, couldn't do anything except wait while bankruptcy proceedings dragged on for months. A bankruptcy trustee was appointed, Jelena McWilliams, who happened to be the former chair of the FDIC. Even with her expertise and authority, the situation took over a year to partially resolve. By November 2025, Synapse's bankruptcy case was dismissed entirely because the company had no assets left to distribute and no way to pay creditors. Some Yotta customers had received partial payments by that point. Many had received nothing. And as of February 2026, the subreddit for Yotta victims is still active with people posting that they're owed $63,000, $30,000, $10,000, and haven't seen a cent. Zach Jacobs, a former Illinois resident, lost $100,000 when his Yotta account was frozen. He created a website called Fight for Our Funds that brought together 6,700 people collectively missing $51 million. That's an average loss of $7,500 per person. These aren't millionaires gambling with spare change. These are working people who put their emergency funds, their savings for college or weddings or medical bills, into what they genuinely believed was a safe FDIC-insured account. And the system completely failed them. Now you might be thinking, okay, that's awful, but that was one specific situation with one sketchy fintech company. I bank with Chase or Bank of America or Wells Fargo. I'm fine. And you might be right. The risk profile is definitely lower with major banks that handle everything in-house rather than relying on third-party middleware. But there are other ways to lose access to your money that have nothing to do with fintech collapses and everything to do with how banks themselves are operating in 2026. And let me tell you about someone we'll call Marcus because he asked not to use his real name. Marcus was a university student, an international student on a visa, in his final semester before graduation. He received a $6,000 wire transfer from his brother to cover tuition and his first month's rent at a new apartment. 3 days later, on a Friday afternoon at 3 p.m., Marcus pulled into a gas station to fill up his tank before driving to his new place with all his belongings in the car. His Bank of America debit card was declined. He called customer service. They told him his account had been flagged for suspicious activity, and he needed to come to a branch immediately with 2 forms of ID. Marcus drove to the nearest branch. When he arrived, they told him the fraud department operated out of New York, 3 time zones ahead, and they had already closed for the day. Come back Tuesday. It was a long weekend. The bank would be closed Monday. So Marcus, who had just received his last paycheck from his campus job and had exactly $9 in cash in his wallet, spent the next week unable to access any of his $6,000. He couldn't pay for gas to finish his move. He couldn't buy food. He ended up sleeping in his car for 6 days in a gas station parking lot because he couldn't afford a hotel and had nowhere else to go. When Tuesday finally came and he got to speak with the fraud department, they unfroze his account within 10 minutes. The transfer from his brother was completely legitimate. There was nothing suspicious about it, except that it was slightly larger than his normal account activity. The algorithm flagged it. A human never reviewed it before the account was locked. And Bank of America's policies don't allow for emergency unlocks outside business hours, even when someone's entire financial life is frozen over a false positive. Marcus missed his tuition payment deadline. The university dropped his classes. As an international student, failing to maintain full-time enrollment meant his visa status was violated. He had to leave the country. He never graduated. The story was shared on Hacker News, a technology forum, and it sparked 900 comments from people sharing similar experiences. Accounts frozen without warning, fraud departments unreachable on weekends, legitimate transactions blocked by overzealous algorithms. And the common thread was always the same. Banks can freeze your account instantly based on automated systems, but unfreezing it requires human intervention during business hours only, leaving you completely helpless if the freeze happens at the wrong time. In January 2026, a new regulation from FINRA, the Financial Industry Regulatory Authority, went into effect. Rule 2166 allows banks to hold wire transfers and large transactions for up to 5 full business days if their systems flag the transaction as potentially fraudulent. The stated purpose is protecting seniors from scams and preventing money laundering. Both are legitimate goals. But in practice, the rule gives banks enormous power to lock your money based on algorithmic suspicion, with no requirement to prove actual fraud before freezing your access. Here's how this plays out in real life. You're buying a used car and need to wire $8,000 to the seller. Your bank's AI sees an unusually large outgoing wire to an individual rather than a business, flagged. Now your transaction is on hold for up to 5 days while they investigate whether you're being scammed or laundering money. Maybe you can call and explain and get it released sooner. Maybe you can't reach anyone with authority to override the system. Maybe it's Friday evening and nobody's available until Monday. Meanwhile, the car seller moves on to another buyer and you lose the deal. Or worse, you were counting on that money reaching your landlord by the first of the month, and now you're facing late fees or eviction while the bank leisurely investigates a transaction that was completely legitimate. The kicker is that these AI fraud detection systems have incredibly high false positive rates. A study from 2025 found that in challenger banks and newer fintech institutions, anti-fraud software incorrectly flags legitimate transactions in up to 15% of cases. That means roughly 1 in 7 customers who try to make larger than usual transactions get blocked even when nothing fraudulent is happening. And when your account gets frozen incorrectly, the burden is entirely on you to prove you're not a criminal. The bank doesn't have to prove you did anything wrong. You have to prove you didn't. Seniors are getting hit especially hard by this. An elderly person who writes checks instead of using debit cards looks anomalous to an AI trained on younger spending patterns. Someone who withdraws large amounts of cash because they don't trust digital payments gets flagged as potential money laundering. A retiree sending money to grandchildren or paying contractors for home repairs triggers holds and investigations. And older Americans often struggle with the technology required to resolve these issues. They can't easily navigate phone trees or use mobile apps to upload documentation. They need to speak with a human in person, and banks have systematically eliminated that option by closing branches and converting remaining locations into advisory centers without teller services. According to banking industry reports, over 11,000 bank branches closed across America between 2020 and 2025. The banks that remain are increasingly appointment only for anything beyond basic transactions. Need to deposit a check? Use the ATM or mobile deposit. Need cash? ATM only? Need to resolve a frozen account? Call the National Customer Service number and wait on hold. During the Fiserv outage in May 2025, when millions of people were locked out of accounts across dozens of banks simultaneously, customer service wait times exceeded 2 hours. And when people finally got through, representatives had no power to do anything except apologize. The system was down. Nobody could manually process transactions. Everyone just waited. That Fiserv outage, by the way, is a perfect example of the vendor concentration risk I mentioned with Yotta. Fiserv provides core banking technology services to over 10,000 financial institutions in America. When they experienced what they called an internal issue during a network infrastructure enhancement, 60 different banking applications went dark at once. Bank of America, Capital One, TD Bank, Navy Federal Credit Union, Ally Bank, Citizens Bank, and 20 other major institutions all lost functionality simultaneously because they all depend on the same third-party vendor. For 12 hours, people couldn't send money through Zelle, couldn't make debit card purchases, couldn't verify if direct deposits had arrived, couldn't access online banking. And there was nothing anyone could do except wait for Fiserv to fix their systems. This is the invisible infrastructure risk of modern banking. You choose your bank based on their interest rates, their fees, their branch locations, their customer service reputation, but you have zero visibility into which technology vendors they use, and those vendors create systemic risk that your bank choice can't protect you from. When Fiserv goes down, it doesn't matter if you bank with a well-capitalized, highly rated institution. You're locked out anyway because the technology infrastructure serving your bank is broken. Now combine that vendor risk with the cybersecurity threat environment of 2026, and the picture gets even more concerning. According to the American Bankers Association, 52% of banking executives predict cyber attacks will worsen this year, with another 43% saying attacks will probably worsen. That's 95% of banking professionals expecting the threat landscape to deteriorate, and they're not being paranoid. In 2025, ransomware attacks on financial institutions increased 43% year over year. The largest banking sector data breach affected over 13 million customer accounts at Prosper Marketplace, a peer-to-peer lending platform. But the breach that should worry you most happened at a company you've probably never heard of. Marquee Software Solutions provides anti-money laundering and compliance services to banks and credit unions. When hackers breached Marquee systems in August 2025, they stole personal information for 824,000 customers across at least 80 different financial institutions. Names, social security numbers, dates of birth, account numbers, transaction histories, all compromised in a single attack on a third-party vendor that most of those customers didn't even know had access to their data. This is the supply chain vulnerability problem. Your bank might have excellent cybersecurity, Fort Knox-level defenses. It doesn't matter if they share your data with vendors who have weak security. And banks are legally required to share customer data with all sorts of service providers for compliance, fraud prevention, payment processing, and record keeping. Every one of those vendors is a potential breach point. Every one of their employees is a potential insider threat. Every one of their systems is a target for hackers. And when a vendor gets compromised, customers from dozens of banks get exposed simultaneously. The sophistication of these attacks is escalating dramatically. Criminals are using artificial intelligence to create phishing emails that are virtually indistinguishable from legitimate bank communications. They build fake websites that look exactly like your bank's actual site, down to the SSL certificate and proper URL. They use AI to clone voices and call pretending to be bank representatives, asking for verification codes or passwords while sounding exactly like a real employee. In 2025, 38% of people who reported fraud actually experienced financial losses, up from 27% in 2023. The scams are working better than ever, and we haven't even talked about the most mundane but perhaps most common way people lose access to their money, which is banks simply closing accounts without warning or explanation. CBS, the New York Times, and multiple other outlets have run investigative reports over the past 2 years documenting customers who had accounts suddenly shut down with vague explanations or no explanation at all. The banks cite their terms of service, which universally include language like, "We reserve the right to close your account at any time for any reason without prior notice." And they absolutely exercise that right. Why do banks close accounts? Sometimes it's legitimate, unusual activity that looks like fraud or money laundering, violations of the account agreement like bouncing too many checks, business use of a personal account. But sometimes the reasons make no sense at all. AI systems flag patterns as suspicious when they're not. Regulatory compliance software automatically closes accounts associated with certain industries or transaction types, regardless of whether anything illegal is happening. And once an account is closed, good luck getting an explanation. Privacy policies prevent bank employees from telling you the specific reason. You might get your money back eventually, but the account is gone and there's nothing you can do about it. Here's what all of this means for you practically. Your money in an American bank is still fundamentally safer than in almost any other financial system on earth. FDIC insurance works when banks actually fail. Regulations ensure adequate capital reserves. Banking crises are handled efficiently, but safe and accessible are not the same thing. Your money can be perfectly protected from bank failure while being completely inaccessible to you because of a vendor outage, a false fraud flag, a third-party bankruptcy, or an algorithm that doesn't like your transaction patterns. So what do you actually do? How do you protect yourself from risks that FDIC insurance doesn't cover? Let me give you specific actionable steps you can implement this week. First, and this is non-negotiable, maintain accounts at multiple institutions, not just multiple accounts at the same bank. Completely different banks using different technology vendors if possible. If your primary bank is one of the major national institutions like Chase or Bank of America, open a backup account at a regional bank or credit union. If you use an online bank like Ally or Marcus, have a traditional brick and mortar bank as backup. The goal is diversification across different institutions with different technology infrastructure so that when one system goes down or one account gets frozen, you still have access to money elsewhere. For most people, keeping your main checking account at one bank, a high-yield savings account at another, and maybe a smaller emergency checking account at a third institution provides good protection. It's slightly more complex to manage, yes, but that complexity is insurance. When Fiserv went down and locked millions out of Bank of America, Capital One, and TD Bank simultaneously, people who had backup accounts at credit unions or regional banks using different technology providers still had access to money. Those who kept everything at banks served by Fiserv were completely frozen. Second, keep physical cash at home. This feels old-fashioned, and many personal finance experts will tell you it's inefficient because cash earns no interest. That's true. But cash at home is the only form of money that doesn't depend on electronic systems working. If there's a prolonged technology outage, if your accounts get frozen during a fraud investigation, if a vendor like Synapse collapses and ties up your money in bankruptcy proceedings, physical cash lets you buy food, put gas in your car, pay for immediate needs while you sort out the electronic mess. How much? Somewhere between $500 and $2,000 depending on your household size and monthly expenses. Store it securely, obviously, but have it available. Third, verify that any banking app or fintech service you use is actually FDIC-insured and understand the structure. Yotta customers thought they had FDIC insurance because Yotta partnered with an FDIC-insured bank. Technically true. But the insurance didn't help when the middleware keeping track of who owned what money collapsed. If you're using apps like Chime, Dave, Cash App, Venmo for banking rather than payments, research which partner bank actually holds the deposits and whether there are middleware companies involved that could create Synapse-style risks. The safest approach is still traditional banks where you have a direct relationship with the insured institution rather than going through fintech intermediaries. Fourth, Set up account alerts for every transaction above a threshold you define, and review your accounts at least weekly. Most banks allow text or email notifications whenever purchases exceed a certain amount, whenever transactions occur in new locations, whenever balances drop below a threshold. These alerts let you catch fraud immediately and also let you know if the bank flagged something incorrectly, so you can call and resolve it before it becomes a frozen account situation. Waiting until you try to use your card and it's declined is too late. By then, you're already locked out and scrambling. Fifth, document everything. Screenshots of account balances, confirmation emails of deposits and withdrawals, records of every interaction with customer service. If you ever end up in a Yotta type situation where the bank claims your money doesn't exist, documentation is your only defense. Yotta customers who kept meticulous records were able to prove they made deposits even when the ledgers showed otherwise. Those who relied on the app to track everything had nothing when the systems failed. Sixth, enable two-factor authentication on all financial accounts and use unique, strong passwords managed through a password manager. This isn't glamorous advice, but it matters. Most account takeover attacks succeed because of weak passwords, reused passwords, or lack of two-factor protection. Criminals steal credentials from one data breach and try them on banking sites. If you reuse passwords, they get in. Two-factor authentication stops this even when your password is compromised because the attacker also needs physical access to your phone. Seventh, reconsider how much money needs to sit in checking and savings accounts versus other vehicles. High-yield savings accounts paying 4% are decent, but inflation running at 3% means you're barely keeping pace. Money you genuinely need for emergencies and near-term expenses should stay liquid in banks. Money you won't need for years might be better served in treasury bills purchased directly from the government through Treasury Direct, in certificates of deposit, in money market funds, or invested in diversified portfolios. This isn't about chasing returns. It's about not having all your assets dependent on a single system that could freeze access unexpectedly. And finally, eighth, build relationships with local credit unions as alternatives to or supplements to big banks. Credit unions are member-owned nonprofits that typically have lower fees, better interest rates, and more personalized service than for-profit banks. Because they're smaller and serve specific communities, they often use different technology vendors than the major banks, providing natural diversification against vendor concentration risk. Alliant Credit Union, Navy Federal Credit Union, Pentagon Federal Credit Union, Consumers Credit Union, these are all examples of credit unions that offer competitive products and may use different infrastructure than whatever bank you currently use. Now, I want to bring this back to the bigger picture because individual protection strategies only go so far when systemic problems exist. The Yotta collapse, the Fiserv outage, the surge in account freezing from overzealous fraud detection, the concentration of critical infrastructure with a handful of vendors, these aren't separate isolated issues. They're symptoms of a banking system that has become incredibly complex, highly automated, and dependent on technology that creates new categories of risk our regulations weren't designed to handle. FDIC insurance was created in 1933 to prevent bank runs after the Great Depression. It works brilliantly for what it was designed to do, protect depositors when banks fail due to insolvency. But it doesn't protect you when a technology vendor goes bankrupt. It doesn't protect you when AI falsely flags your account. It doesn't protect you when cyber criminals breach a third-party service provider. These are 21st century problems, and we're using 20th century solutions. The Synapse collapse specifically led to calls for new regulations. In October 2024, the FDIC proposed what's being called the Synapse rule, requiring banks to maintain accurate record-keeping of beneficial owners and custodial accounts. That's a start, but it doesn't address vendor concentration risk. It doesn't address the banking-as-a-service model where fintech companies can offer bank accounts without being banks. It doesn't address what happens when the middleware keeping track of customer balances fails. The rule would help prevent another Synapse maybe, but it won't prevent the next Fiserv outage or the next wave of false positive account freezes. Meanwhile, 19 months after 85,000 people lost access to their money, many still haven't recovered everything. The Synapse bankruptcy case was dismissed in November 2025, with no assets remaining to distribute. Some Yotta customers got 99% back, some got less than 1%, some got nothing. Zach Jacobs' website, Fight for Our Funds, is still active, still coordinating advocacy for reimbursement. The subreddit is still full of people posting about how much they're owed. And Yotta itself, rather than being shut down, pivoted to offering casino-style gambling games. They took people's savings app and turned it into blackjack and roulette, funded by microtransactions. You truly cannot make this up. This is the reality of banking in 2026. Your money is safer than it's ever been from traditional bank failure. Capital requirements are strong. Regulatory oversight is robust. The FDIC is well-funded, but your access to that money is more fragile than you probably realize. A vendor you've never heard of can fail and lock you out. An algorithm can flag you incorrectly and freeze your account. A cyber attack on a third-party service provider can expose your personal information. A middleware company can go bankrupt and tie your deposits up in legal proceedings for years. And through it all, the system treats you as the problem rather than the victim. The banks will say they're protecting you from fraud. They'll point to the billions lost to scams annually and argue that aggressive fraud prevention saves more money than it costs in false positives. There's some truth to that. But when the protection mechanisms leave legitimate customers unable to buy groceries or pay rent or afford medical care because algorithms decided their normal behavior looks suspicious, something is badly wrong. When an international student ends up homeless for a week because a $6,000 wire transfer from his brother gets flagged on a Friday afternoon and nobody can unfreeze it until Tuesday, the system has failed. What makes this especially frustrating is that the technology exists to do this better. Continuous authentication that verifies identity throughout a session rather than just at login. Real-time human review of flagged transactions for amounts above certain thresholds. Redundant systems, so a single vendor failure doesn't cascade across the entire banking ecosystem. But implementing these solutions costs money and reduces efficiency and cuts into profits, so most banks haven't prioritized them. Instead, they've prioritized automation, cost-cutting, branch closures, vendor consolidation, and all the other strategies that maximize short-term profitability while increasing systemic fragility. And when things break, when people lose access to their money through no fault of their own, the banks hide behind terms of service and regulatory requirements and claim they're just following the rules. They are. The rules are the problem. So here we are in February 2026 with a banking system that's simultaneously safer and more fragile than it's ever been. Safer from insolvency. Fragile from dependency. Your bank probably won't fail, but your access might. And the protections that save you from one don't save you from the other. The only rational response is redundancy. Multiple banks, multiple access methods, physical cash, documentation, constant vigilance. It's exhausting. It shouldn't be necessary, but it is. Sarah Thompson looked at her Bank of America app showing zero balances that October morning in 2024 and felt her heart stop. Konstantin Tarnarutsky tried to withdraw his $7,400 from Yotta and watched it disappear into bankruptcy proceedings. Marcus spent a week sleeping in his car because an algorithm flagged a legitimate wire transfer. These aren't edge cases. They're warnings. They're what happens when access depends entirely on systems that can break, vendors that can fail, and algorithms that make mistakes. The question isn't whether you'll ever face something like this. The question is when, and whether you'll have prepared enough redundancy that it's an inconvenience rather than a catastrophe. Because in 2026, the stability of your bank and the accessibility of your money are two completely separate problems. And solving one doesn't solve the other. You have to solve both yourself. Let me give you one final piece of perspective that ties all of this together and explains why these problems are accelerating rather than improving. The banking industry is in the middle of a fundamental transition that most people don't realize is happening. For decades, banks made money primarily through the spread between what they paid on deposits and what they charged on loans. You put money in a savings account earning 2%. They lend it out at 6% mortgages or 8% car loans, and they pocket the difference. Simple business model that worked for generations. But in the era of near zero interest rates that lasted from the financial crisis through 2021, that traditional model stopped working. Banks couldn't make money on interest rate spreads when rates were effectively zero. So they pivoted to fee-based revenue. Overdraft fees, maintenance fees, wire transfer fees, ATM fees, insufficient funds fees. They also leaned heavily into technology automation to reduce costs, close branches, eliminate tellers, automate everything possible, outsource to specialized vendors who could achieve economies of scale. This transformation happened incredibly fast. Between 2010 and 2025, the number of bank employees in America dropped by over 200,000, even as the population grew and banking assets increased. The jobs didn't disappear because banks were shrinking. They disappeared because technology replaced humans. And that technology, because it's expensive to build in-house, came from vendors. The same vendors serving hundreds or thousands of banks simultaneously, creating the concentration risk we've been discussing. Now, interest rates are back up. The traditional lending model is profitable again, but the industry hasn't reversed course on automation and vendor reliance. They've doubled down because the cost savings are too attractive. A human bank teller costs roughly $40,000 a year in salary and benefits. An AI chatbot handling customer service inquiries costs pennies per interaction. The economic incentive is overwhelming, even though the human provides better service and catches problems the AI misses. This cost-cutting efficiency obsession is why when something goes wrong, when a Fiserv outage happens or a fraud algorithm makes a mistake, there are fewer humans available to fix it. Customer service departments have been slashed, branch staff reduced to skeleton crews. The expertise to manually process transactions when systems fail has been deliberately eliminated as unnecessary expense. So when the automated systems break, nobody can step in. Everyone just waits for the technology to be fixed. Compare this to how banking worked even 20 years ago. If your account got frozen, you walked into a branch, spoke with